Good morning everybody, and thank you for joining us this morning for our webinar on options for directors in financial difficulty. I'm Laura Michelle Moore and I'm a technical manager within the professional accountancy team at Chartered Accountants Ireland. I've worked in insolvency for many years and have a keen interest in this topic also. I would like to welcome this morning our guest speaker Ian Barrett of KPMG. Ian has a wealth of experience providing business and restructuring turnaround advice, and please feel free to use the Q&A function, and Ian will be answering some questions towards the end of the hour as well. Thank you very much, and I will see you later.
Many thanks, Laura Michelle, and good morning and welcome to this webinar on directors' duties and obligations in financial difficulty. My name is Ian Barrett and I'm a Managing Director in KPMG's Restructuring and Forensics practice. Before we start, I'll just quickly run through the agenda of topics we'll be covering this morning. I look at directors' duties and obligation in the normal course and also when a business is facing insolvency. Then moving on to signs of financial distress which directors need to be aware of, followed by an overview of the company insolvency test, moving on to the practical steps boards should take when their business is in financial difficulty. Also covered are common errors or mistakes made by directors which we would see as insolvency practitioners, especially during the winding up of a company. And finally, I'll give a brief overview of formal restructuring options for directors to consider. So just moving on to an overview of this topic, given its importance. Over the last while, there has been and continues to be a lot of media coverage of the challenging economic environment with a lot of uncertainty and potential financial difficulties facing businesses. During the COVID-19 pandemic, there can be no question that a high volume of corporate insolvencies was avoided due to various government supports, tax warehousing and creditor forbearance. These supports gradually came to an end with tax warehousing scheduled to end for certain businesses in 2023 and 2024. This is along with various other challenges such as rising interest rates. We've just experienced the highest inflation for almost 40 years, cost of energy crisis, the invasion of Ukraine, along with other challenges such as labour shortages and supply chain issues. These challenges will impact businesses in different ways but have of course resulted in increased operating costs, higher costs of debt, potentially reduced demand and output disruption. All of this places enormous pressure on the financial position of businesses and their future viability. There are predictions of a recession in some European countries in 2023. The UK predicted as being the most likely, with Ireland predicted to avoid recession this year, but nonetheless, these challenges exist and will continue for the foreseeable future, which makes this a very important matter for company directors to be aware of, as their business may be faced with potential insolvency in the future. So just moving on to the next slide now, in relation to directors' duties and obligations, Section 228 of the Companies Act 2014 sets out the statutory duties and obligations of a director, which are summarised here and we would all be familiar with. In the normal course of business, a director's duties are to the company and its shareholders. Section 228 also covers a director's conduct when managing the affairs of a company, where directors must always act honestly and responsibly. On the 27th of July 2022, the European Preventative Restructuring regulations were signed to give effect to an EU directive. The EU regulations introduced changes to the provisions of the Companies Act 2014, giving statutory recognition to the duty to have regard to creditors' interests, and when the directors have reasonable cause to believe that a company is or is likely to be unable to pay its debts, the statutory duties under sections 224A and 228 of the Companies Act 2014 apply. Traditionally, the fiduciary duties of directors were extended in situations where a company is insolvent, requiring directors to have regard to the interests of the company's creditors, and this has been dealt with in some legal proceedings over the years. But the regulations for the first time place a statutory obligation on the directors to have regard to the interests of the company's creditors. The need to take steps to avoid insolvency and avoid deliberate or grossly negligent conduct that threatens the viability of the business of the company. The obligation is imposed on directors where directors become aware of the company's insolvency, which makes it very important for directors to be cognizant of the early warning signs of financial distress. In early January 2023, the Corporate Enforcement Authority published helpful guidance note on the regulations, and the link is on this slide, We will come back to this shortly, but the new statutory fiduciary duties of directors are enforceable in the same manner as a breach in the traditional fiduciary duties of directors. So leading on from the previous slide, just in relation to signs of financial distress, where I mentioned the importance of directors being aware of signs of financial distress, there are a number of signs, indicators which show that a business is in financial difficulty. And covered on the slide is a non-exhaustive list of such warning signs. It is laid out in terms of the earliest or latest when you would typically expect these issues to arise in closer to insolvency. However, some could arise earlier or later than others. So there's no exact science here. Businesses in financial difficulty will not face all of these issues, but a build-up of some of these issues without planning or decisive action taken by a board may leave it too late for a business to explore feasible restructuring solutions. A common point you will hear restructuring professionals always make is that directors or business owners should act early when potentially facing insolvency and seek professional advice. And a good example of this can be seen on this slide, where the later signs of distress are more serious and having little room for manoeuvre for a company. So focusing more on the later signs of financial distress, receiving a petition to wind up effectively means the decision to wind up the company is being taken out of the company's hands by a creditor. Unless the outstanding balance is paid or legitimately disputed, the court would likely grant an order winding up the company and to appoint a liquidator. Demands from the revenue commissioners or repossession of assets by a county or city sheriff or by a creditor through a retention of title clause are serious signs the company is struggling to survive. Eviction notices for clear breaches of lease terms, such as non-payment of rent, also make it difficult for a board to form appropriate solutions to continue to trade, and the liquidation of the company becomes far more likely at this point. Delaying decisions and seeking professional advice and taking steps to try and resolve a company in financial difficulties will likely worsen its financial position, resulting in a lower chance of the business ultimately avoiding closure. However, at this late stage, there can be solutions found such as examinership or SCARP, which I will cover later. Moving on to the next slide, in relation to the company insolvency test. Here we look at the company insolvency test, where there's two tests that are applied to determine whether a company is insolvent, are the cash flow test and the balance sheet test. In terms of the cash flow test, the question is, can a company pay its debts as they fall due? This shows the importance of a board preparing regular and detailed cash flow projections with focus on the immediate or short-term cash flow requirements for a company, and should identify the funding requirements for a business to continue to trade. The balance sheet test should also be applied to show whether the company has sufficient assets to discharge its liabilities. This test would also focus on whether it can meet longer-term liabilities over time based on its asset position. Directors using these tests will need to analyse whether they can survive, and if not, explore the various restructuring options available to them. When doing this analysis, there should also be key issues for a board of directors to consider. For example, can the business trade out of its financial difficulties, and professional advice should be obtained when considering this. What are the reasons for the company's underperformance and liquidity problems, and can these problems be addressed by the company? What are the company's prospects over the medium to long term? In other words, if the company gets through its current financial difficulties, how could it perform in the foreseeable future? What is the required for the company to survive? For example, what key funding requirements and its timing, what would be driven by its cash flow projections? A board may also consider disposing of assets or closing part of the business to generate funds to invest into the company to meet its working capital requirements. If a board considers this as an option, it should take professional advice to ensure that the disposal is in the best interest of the creditors. In other words, is the board getting the best value for the asset it is disposing of? Does the company need to refinance or restructure its longer-term debt obligations? And also, is this feasible? Are the creditors about to take enforcement action, for example, petition for the winding up of the company, or are secured creditors considering the appointment of a receiver over the company's assets? So as mentioned earlier, a company in this situation will be very close to a formal insolvency appointment and potentially closure, but based on a given situation, there could be restructuring solutions for the directors to explore at that point by seeking professional advice. On the next slide, in relation to practical steps for directors, it's an overview of just the steps initially should be taken across 4 different headings, which I will cover in detail over the next couple of slides. Many companies facing financial difficulty may be doing a lot of this already, but if not, it is very important to adopt a similar approach to ensure a board is fully aware of a company's financial difficulties and also be in a position to deal with these difficulties as soon as possible. Even in situations where companies are solvent, it is expected to remain solvent but are dealing with the economic headwinds. Some of these steps can be taken as a prudent approach by directors to take closely monitoring how the business is coping with the various challenges mentioned earlier. This will be covered later on, but a liquidator of a company is required to submit a report to the Corporate Enforcement Authority on a director's conduct and whether they acted honestly and responsibly before the date of liquidation. If a board takes these practical steps or a similar approach, it can be demonstrated to a liquidator that the board was trying to act in the interests of the creditors. But just to be clear, this approach does not absolve directors if other offences were committed, but it can go a long way to showing the directors were taking a practical approach before a liquidation and were genuinely trying to salvage the business. So moving on to the next slide on practical steps. In relation to maintaining accurate books and records, all financial information should be accurate and up to date to ensure decisions made by management and the board are based on a clear picture of the company's financial position. This is also very important as directors need to be aware if there is a likelihood that a company will be unable to pay its debts as they fall due, in accordance with Section 224A of the Companies Act as covered earlier. It goes without saying that out-of-date information is of little or no use, especially when a company is in financial difficulty. So summarised below are some recommended board pack contents which a board can use to continuously assess the financial position and future viability of its business. A board pack should ideally include latest cash flow position, the latest set of management accounts, latest cash flow and trading projections, up-to-date creditor balances outlining movement per creditor since the previous update or during the relevant period, an update on progress with any funding or refinance options being explored by the company, and also an update on any discussions with creditors. So, for example, have any commitments being given to upcoming payments or stage payment plans agreed with creditors. Depending on the nature of the business, other trading key performance indicators may also be monitored and included in board packs for discussion and ongoing monitoring. Another very important point is that directors have a statutory obligation to ensure proper books and records are kept in accordance with Section 282 of the Companies Act. I will come back to this point later on. Just moving across the financial position on outlook, I would strongly recommend that a business plan for the next 12 months should be prepared, and if one was recently prepared, it should be updated with realistic targets and outcomes projected by management and by the board. The plan should also address what investment or financing is required to keep the business afloat. The plan would need to contain financial projections for the 12 months, but it is critical to prepare and maintain conservative cash flow projections, which are appropriately stress tested across a number of scenarios. This illustrates the impact of certain unfavourable or potentially favourable events on the company's financial position and what corrective action, if any, can be taken. So, for example, the company adjusted its financial projections to deal with inflation, recent rises in interest rates, any labour shortages which are reducing capacity and therefore the output of the business, the removal of government supports, fall in demand for its goods or services, or the possible loss of a large customer. A sensible approach is for projections to be adjusted and reviewed for reasonableness and prudence purposes, as projections based on out-of-date information or assumptions will be misleading for a board. There needs to be a close focus on the working capital position of the company and can it be improved. So, for example, can debtors be collected quicker? Can stock levels be reduced to more appropriate levels, along with focus on aging creditors, and are the credit terms manageable? Immediate steps should be taken to cut costs where possible in order to reduce losses and maximise exposed creditors, although this might not also always be inappropriate depending on the circumstances for the business. All funding and finance options should be considered by the directors. For example, shareholder investment, disposal of non-core assets to fund the business, or loan finance, or even refinancing current loan facilities. So just moving on to the next slide on governance. Strong governance, which should be the norm for all companies, is critical in times of uncertainty or financial difficulty. When a business is in financial difficulty, any key decisions made by a board on the basis of these decisions should be documented. For example, what information was relied on and was any professional advice obtained or considered. Through strong governance and documented decision making, the creditor's interest must have been shown to have been considered by the board. If it is recognised that a company is insolvent and the board are exploring restructuring or financing options, only payments critical to preserving value in the business and allowing it to continue to operate should be approved. So coming back to an earlier point I made in a potential subsequent liquidation, this could show a liquidator how the board contemplated certain key decisions and why certain actions were taken, such as why certain creditors were paid in order to keep the business functioning. More frequent board meetings should be held to review the latest financial information and board packs, the contents of which I presented just in the previous slide. In relation to professional advice, over to the right, sensible approach for boards can be to take professional advice from restructuring professionals. This advice would provide options for a board and recommended steps to take depending on a company's financial position. As I mentioned earlier, if directors are considering a disposal of the company's assets or closure of part of its business, they should take professional advice on the appropriateness of this and whether it is ultimately in the interest of the creditors of the company. Obtaining expert advice can mitigate the risk of error and potentially worsening the financial position of the company to the detriment of its creditors. And crucially, the new EU regulations, which were covered earlier as per Section 2248 of the Companies Act, there is an obligation to take steps to avoid insolvency. So seeking advice from insolvency practitioners at the earliest possible opportunity enhances the possibility of avoiding solvency. In its information note, the Corporate Enforcement Authority also recommends professional advice is obtained from insolvency practitioners as soon as possible after the directors become aware of its financial difficulties. On the following slide on common pitfalls and errors, here are just a summary of a number of pitfalls or errors that insolvency practitioners come across after their appointment as liquidator. Essentially, these errors are contrary to what has been recommended on the previous slides in relation to practical steps that should be taken by directors when their company is in financial difficulty. Some also arise by not seeking professional advice, leading to incorrect decision making, possibly exposing the directors to enforcement action as a result of a breach of their statutory duties. So for example, not holding board meetings and documenting all correspondence, discussions and no proper governance or board's oversight of a company can be deemed irresponsible by a liquidator, especially in circumstances where the board ought to have known at an earlier stage that when they realised the company was insolvent. We touched on this earlier. A liquidator will also look at how a board functioned in the lead up to a company's insolvency. Ceasing to trade when continuing to trade would have preserved creditor asset value better is also an issue. This would be an example where professional advice was needed. Making unfair preference payments in the lead up to a company's liquidation. This would be preferring a payment to a certain creditors over longer outstanding creditors without justification, or more commonly, making payments to connected parties over other unconnected creditors. Other issues such as failing to keep tax affairs in order is another common error. Open engagement with the revenue commissioners is important, especially on tax arrears. Options such as agreeing PPAs with the revenue, which stands for phased payment arrangements, is of course an action open to all companies who are struggling to deal with tax arrears. Failing to keep management accounts or financial statements up to date, this would also be a breach of Section 282 of the Companies Act. Or failing to engage with creditors in any capacity, failing to consider the appointment of an examiner, liquidator or a process advisor, and also failing to seek legal or professional advice in the insolvency position of the company or the best course of action to take can rise with issues. Attempting to trade out of insolvency when not appropriate to do so is a very risky approach to take without obtaining professional advice, and also a failure or refusal to cooperate with a liquidator can also contribute to enforcement action against the director. On the next slide, covering the risks for directors. who fail to meet their statutory obligations. Just to recap, in an insolvent liquidation, a liquidator is obliged to carry out an investigation into the affairs of a company and the reasons behind its insolvency. And as part of that investigation, the liquidator needs to review the conduct of the decisions in the lead up to the company's insolvency. The outcome of this investigation is set out in the Section 682 report, which the liquidator is required to submit to the Corporate Enforcement Authority within 6 months of the date of liquidation. If a liquidator is not satisfied the director acted honestly and responsibly in relation to a company's affairs, the liquidator must apply to the High Court for the restriction of the director. A restriction order results in a director being restricted from acting as an officer of a company unless that company has paid up share capital of €100,000 in cases of private companies or €500,000 in the case of listed companies. A liquidator may apply for a disqualification of a director if it is deemed the director is unfit to be concerned in the management of the company. A person can also be disqualified if they have been convicted of a criminal offence. So if a director is disqualified, it is a more serious consequence as they cannot act as an officer of a company under any circumstances. It is usually for a period of 5 years, but can be longer depending on the severity of the offences. So to be clear, a disqualified director cannot act as an officer of a company, to be involved in the promotion, formation or management of any company regardless of the share capital position of the company. A combination of some of the pitfalls and errors mentioned on the previous slide can result in the restriction or disqualification of directors. Directors who do not cooperate with a liquidator will hamper a liquidator's investigation into the company's affairs and also fulfil his or her reporting obligations to the Corporate Enforcement Authority. A liquidator will consider the level of cooperation from the directors when forming an opinion on a director's conduct. Just touching briefly on reckless trading, which is more rare, a director may be personally liable for the debts of an insolvent company if they knowingly carried on the business in a reckless manner. In other words, where the director should have known that their actions will cause loss to the creditors, or where they allowed the company to incur debt when it was known that the debt would not be paid as it fell due. So just on to the next slide, and firstly dealing with fraudulent trading. A director may be held personally liable for the liability of an insolvent company where he or she knowingly carries on the business with the intent to defraud creditors, so again rare. The failure to keep proper books and records is also an offence, as mentioned earlier. Section 282 of the Companies Act 2014 sets out the basic requirements for accounting records, and unfortunately many insolvent companies have fallen below the standard required. Section 286 of the Companies Act sets out the offences for not keeping proper books and records. It is a criminal offence for a company to fail to keep proper books and records. It is also a criminal offence for a company director to fail to take all reasonable steps to make sure that if a company fails to keep proper books and records. Failure to file annual returns and annual accounts is also a breach of the Companies Act, and it deprives the public from understanding the financial position of a company at a given point in time. While it is very rare, a liquidator can apply to court to seek to have a director made personally liable for all the debts of a company where his or her failure to maintain proper books and records has contributed to the company's insolvency and has disrupted the winding up of a company. So moving on to the next slide, in relation to formal restructuring processes, just giving a brief overview of the formal restructuring processes, and given the time we have, I'll only briefly cover these processes. If you have any queries on these processes, please get in touch. My contact details will be on the last slide. So looking firstly at two corporate rescue processes available to insolvent companies, examinership and the Small Company Administrative Rescue Process, also known as SCARP. Examinership and SCARP are formal insolvency processes that allow a company to restructure its debts and continue to trade. The processes allow a restructuring of the company's debts by way of a compromise arrangement with its creditors, where a proportion of debts are usually written off and the company agrees to pay back a lower proportion of the remaining debt. Examinership is a restructuring process where the company must be insolvent and an examiner is appointed on foot of a petition to the High Court or the Circuit Court. The company or part of it must have a reasonable prospect of survival, and the petition submitted to the courts is accompanied by an independent expert's report. The report from the independent expert provides an opinion that, given certain conditions, the company has a reasonable prospect of survival. The company is granted protection for a period of up to 100 days from enforcement action by creditors, while the examiner seeks to form a scheme of arrangement which is essentially a rescue plan for the company to restructure its debts. The scheme will very likely result in the cross-cram down of debt for various creditor classes, and the scheme must be approved by over 50% in value and number of one impaired class of creditor, and once sanctioned by the court, the scheme is binding on all creditors. SCARP was introduced as a more affordable process for small and micro companies in Ireland, given that these companies make up around 98% of all companies incorporated in Ireland. SCARP contains many of the key elements of examinership, but one main one being that a successful SCARP involves the approval of a rescue plan, which is the SCARP version of a scheme of arrangement, resulting in the cross-cram down of various classes of creditors. There are some key differences, so SCARP is available to small and micro companies and involves the appointment of a process advisor. 2 out of the 3 criteria need to be met to be regarded as a small company in accordance with the Companies Act, such as turnover of less than 12 million, less than 50 employees, and assets less than 6 million. Micro company criteria is much smaller, which turnover is less than €700,000, less than €350,000 in assets, and an employee headcount of less than 10. No protection from creditor enforcement is automatically granted during SCARP, but it can be obtained by the process advisor by applying to court. The process advisor is appointed by way of a director's resolution after the process advisor has provided a report opining that the company has a reasonable prospect of survival. The creditor approval threshold for a SCARP rescue plan is slightly higher. It's one impaired class creditor with a value greater than 60% in value and number, which is, as I said, slightly higher than 50% in an examinership. The SCARP process lasts only 70 days, but the rescue plan must be voted on by creditors before day 49, allowing for a further 21 days period for the creditors to lodge an objection to an approved rescue plan by applying to court. So in summary, SCARP is designed to be a cheaper or more effective than examinership due to its shorter process and lower court involvement, all going to plan. But SCARP and examinership are feasible options to potentially insolvent but viable businesses looking to continue to trade and should be explored by directors. So moving on to the next slide now in relation to formal restructuring processes and winding up. As mentioned earlier, it is very important for directors to understand that they are legally responsible to take steps to wind up a company once they realise it is insolvent and cannot continue to trade. Dealing firstly with liquidations, there are 2 types of insolvent liquidation: a court liquidation and a creditor's voluntary liquidation. Court liquidation is where a company, through either its directors, shareholders or creditors, makes an application to the High Court to have a liquidator appointed, as the company can't pay its debts as they fall due. Court liquidations also include the appointment of a provisional liquidator, where the appointment of a liquidator is required quickly to preserve or safeguard the assets of the company and possibly operate the business for a period of time while the liquidator explores a potential sale of its business and assets. A creditor's voluntary liquidation is where a company can no longer meet its debts as they fall due, the company has ceased trading, and the board of directors and its shareholders place the company into liquidation. Creditors' meeting is then convened where the appointment of a liquidator is made. Key duty for a liquidator in both processes is to realise the maximum value of a company's assets and distribute surplus assets after liquidation costs to the creditors of a company in order of their priority. A liquidator is also required to deal with employee claims for redundancy, arrears of wages and holiday pay, minimum notice and other entitlements where relevant. A liquidator will also deal with the retention of title claims from creditors who wish to retrieve goods supplied to the company but not paid for. As discussed earlier, a liquidator has an obligation to report to the company's corporate enforcement authority, and a Section 682 report is required to be filed with the CEA within 6 months from the date of liquidation. And finally, a liquidator's other various statutory obligations in line with the Companies Act, such as filing liquidation returns with the CRO, holding of AGMs of members and creditors, and statutory notice to be published concerning their appointment, and for the adjudication of creditor claims. Liquidators also need to be cognisant of other legislation, for example employment, tax, environment legislation, and also GDPR obligations. Just moving on to receiverships, a receiver is appointed by a secure creditor, usually on foot of a mortgage or a debenture granted by a company over its assets. Usually it charges over all the assets and undertakings of a business where a receiver and manager is appointed, which the receiver takes possession of. When possible and when it makes sense, a receiver will consider to operate a business to maximise the realisable value of the secured assets and ultimately attempt to sell the business and assets as a going concern. A receiver can also be appointed over the shares of a company or certain assets of a company by way of a fixed charge. Court-appointed receivers are appointed by the High Court by way of an equitable acquisition over assets subject to a judgment debt. A court-appointed receiver is an officer of the court, and the court order sets out the powers of the receiver. Powers of a receiver are also included in the mortgage or charge, which is granted by the company and the foot on which the receiver is appointed. Also, powers and functions and duties of a receiver are set out in section 437 of the Companies Act. So finally, just to recap, covering the main takeaways from this morning's webinar, we are fully aware of the difficult economic situation and environment, headwinds posed by significant challenges to businesses across a variety of sectors which are threatening the survival of companies. Directors of companies in financial difficulty must have regard to the interests of the creditors where there is an extension of their statutory duties in the normal course of business. Directors concerned about a company's future should assess its financial position and viability without delay, and should also ensure its books and records are maintained and kept up to date with constant monitoring of the financial position. Strong governance with regular board meetings to discuss the company's affairs, its future prospects and financial position are also critical, and directors need to be aware of the personal risks they face for not acting in accordance with their statutory obligations, and should not hesitate to seek professional advice from insolvency practitioners if in doubt on any restructuring options, which is in line with the Corporate Enforcement Authority's guidance note I mentioned earlier. So that concludes the presentation, which I hope you all found useful, but if you have any queries on any of the issues covered, please get in touch. My contact details are on the last slide. And I now hand you over to Laura Michelle with some questions raised during the presentation, which we will try get through based on the time allotted. Thanks very much.
Thank you, Ian. That was hugely informative, and there was a huge amount in there as well. So now we will have a look at some of the questions that have come in. So just having a look. What steps can I take to protect myself as a director if the rest of the board wants to continue to trade and I don't believe that that's in the best interests of the company or the creditors?
Okay, yeah, it's a difficult spot, obviously, to be in. I think it goes back to actually the practical steps we went through. I mean, the director could be wrong. The company might not be insolvent. It could be going through a difficult patch and it might be okay. And that's possibly what's causing the difference of opinion amongst the board. But I think if there's possibly a strong concern there, some of the steps that can be taken is certainly to get professional advice in the financial position, and that will focus the minds of the other directors. If there's a refusal to do that, and it's pretty obvious the company's in financial difficulty, that's where your governance kicks in to protect that personal position of the relevant director raising the objections, and it could be documented in board minutes as well where these concerns were flagged. And I think worst case scenario, if there's just complete fallout at board level and that director is not being listened to, the director might consider taking steps to resign from the board. But that's ultimately, if a liquidation happens within 12 months of that, that director still is within the scope of the liquidator's investigation into the company's affairs and the report to the Corporate Enforcement Authority. But it's about getting it documented and getting the right advice, and also the director being correct. As I said, the company actually could be okay, it's just going through a difficult patch.
Great, no, thank you. That actually covers off, I think, one of our other questions as well. So how long is the director liable for if they resign prior to the company becoming insolvent? So I think you have covered that off, but if there's anything else that you might want to add.
Yeah, like it's if there were serious errors made, right, and some of the more serious offences we covered, resigning just before liquidation also at the same time doesn't kind of save you either, right? But look, if a director had the interests of the creditors at heart, was following their statutory duties and obligations, and was following proper procedure, had all of this documented, the director shouldn't have anything worried about. Like experienced insolvency practitioners would have come across this quite a lot. It's not uncommon, I suppose, and But if there were other offences committed, resigning doesn't prevent any enforcement action.
Of course. I know you spoke about SCARP as a survival means for a company, potentially insolvent company, and obviously we are aware that's a very new process. So another question has come in here just around the success rate on SCARP to date. Has there been 24, 25 cases to date?
I think it's around 23, 24, and around 70% is the number being touted at the moment. There's a few rescue plans being challenged in courts as well by creditors, so that number will be ultimately skewed. But it's been there hasn't been a huge volume in SCARPs to date, right? But that's kind of aligned with the number of insolvencies that have happened since COVID ended, or certainly from the pandemic, and they are artificially low, as I described earlier, because of all of those supports. And I do expect the process to be availed of a lot more this year. Sure, from the second half of last year, the numbers started increasing, the volume of SCARP started going up. So even getting the Revenue Commissioner's viewpoint as well recently at a presentation, they believe that they expect to see a volume of these appointments going up as well. So it seems to be working well, but it's something that just needs to be planned well for in advance as well.
And just on revenues, their viewpoint, are they happy to cooperate with process advisors and companies?
Yeah, and they've kind of backed that up by their position on the plans to date. I mean, they're not opting out in the vast majority of the processes. Like revenue, when you have statutory grounds to opt out, so they can't just pick and choose or be inconsistent. They have to have statutory grounds to opt out, so they would be not having tax affairs in order. And by the way, having warehouse tax debt doesn't mean your tax affairs are in order. I'm talking about the current position with the warehouse tax to be revisited or paid back from either this year or next year, depending on your arrangement with revenue. But if you're undergoing an appeal on an audit or a revenue audit, they will opt out on those statutory grounds. But their view is if your tax affairs are up to date, and this is what they've communicated to restructuring professionals at a presentation, they'll stay in the plan, but they want to see a sensible rescue plan for a viable business and kind of a change in direction in the strategy of the company as well, not just more of the same.
Perfect. Just one other question, and again on the survival mechanisms. What would be key to a successful examinership or SCARP process?
Yeah, it has to be a well thought out rescue planner scheme, right? And the rescue planner scheme has to give creditors a better outcome as a going concern, so an exit from SCARP or examinership than liquidation, right? So that's where you would get statutory challenges or strong challenges by creditors. If they believe they can do better in a liquidation, they're clearly going to challenge a rescue plan or a scheme. They're in the vast majority of certainly examinerships and SCARPs anyway we've heard of, there would need to be investment coming from somewhere, whether it's internal investment, more funds put up by a shareholder or director, or new third party investment. Then that's critical. The rescue plan needs to be funded, or the scheme of arrangement needs to be funded. But it all needs to be planned well in advance, right? Like SCARP is a very short process. 6 weeks is a very hard time to go and seek support or investment for a business. But examinership isn't very long either, like 100 days, 3 months, just over 3 months. That's a very quick process as well, okay? So jumping into these processes without getting advice, without planning, means you're on the back foot from the get-go. So that's also critical. But also having your tax affairs in order. If you're starting the wrong foot with revenue, it's difficult to get their support back in and stay have obligations of their own in terms of maximising the recovery of their debt.
Just a couple more questions that have come in the last few minutes. Where do I find a list of process advisors? So for somebody looking to potentially engage a process advisor and then start a SCARP process. Yeah,
I think on the Institute website you have a lot of materials up about from the various insolvency practitioner firms as well. It would be all the main accountancy firms in the country have them as well. and you have to have certain qualifications as well to act as an insolvency practitioner. But it's certainly the industry website, I think, is probably one of the best ones to go to for that. And Restructuring and Insolvency Ireland, which is a representative body of insolvency practitioners and solicitors, is also a good source as well. The main insolvency practitioners certainly would be members of that.
Oh, great, thank you. Yes, we do, on the Institute's website, we do have our technical hub, which there is a link for later on and just towards the end of the slides. So we do have lots of information there in the insolvency section, and we do have a dedicated SCARP webpage as well that we're continuously adding to. Just one other question we have here, and we might have time for it now. Are there any restrictions on directors where a liquidator has decided that they've acted correctly and in accordance with the laws? So presumably when a liquidator has sought relief from the Corporate Enforcement Authority, is there anything, I suppose, any comeback on a director in that scenario?
Generally not, no. I mean, like parking, personal guarantees or other arrangements directors may have made with creditors. Personally, usually when a liquidator concludes his or her investigation and they've decided that the directors were honest and responsible and there's no grounds to restrict, that's the end of it. The only time certainly I've seen or heard of that position changing, if further evidence comes to light, that would actually change the liquidator's opinion, and that would have to be investigated further. But like, a liquidator would engage as much as possible with directors, and they'll give them the opportunity to give their side of the story. They will raise queries with them during that period when they're doing their investigation, and best practice really would be a liquidator would set out his or her opinion in advance of submitting the report, so the directors kind of would get a final chance to put their best foot forward and maybe challenge the liquidator's view. So if a liquidator had the view, look, I believe you've fallen short in your statutory obligations, your duties as director, and I have to seek restriction and not seek relief from restricting you, a liquidator really should give a director the chance to kind of give a rebuttal to that if they're able to, you know. But if the evidence has to be kind of objective as well, you know, like there has to be kind of factual evidence for a liquidator and a director to rely on. But usually once the liquidator is finished, and the CEA agrees with the position,
yes,
the CEA can challenge the liquidator as well. But once the CEA concludes their position and agrees with the liquidator, that's usually the end of it.
Great, thank you. I don't think we've any other questions coming in on the chat now, so we might finish up and leave it there this morning. So thanks once again to Ian and to the audiovisual team here in KPMG's offices. And like I said, don't forget to contact Ian or myself if you've any queries or comments or anything like that afterwards. And please do have a look at our technical hub on the Institute's website as well. Thank you very much.